got that G, got my nullos. I'm just saying. We pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
I got chills, then multiply.
So hello everyone, it's Saudi and I'm back for another video and I hope you guys are having a good time. Welcome to my channel, honey. Woo! So option trading, let's get into this. I know this world is all about this kind of fat boy. That's why I'm like, guys, I don't understand this world with these people, but I am getting it. So I'm trying to share this with you guys, beginners like me, because when I got into it, no one taught me anything and I've always been scared about it. So I was like, wait, I was so scared to get into this. How about I break it down to the way that it became suitable for me to go into it? So you guys, you got this, okay? So long put option strategy, okay? So a long put option involves purchasing a put option by itself. I have told you guys what a put is, right? You're putting down the phone so you believe that this stock may keep depreciating. So what you do is you buy a put, okay? And when you buy a put, it shows long puts, okay? That's where the word comes from. In other words, you're saying, okay, if your stock has been, let me say you bought the stock at $10, now you're like, let me see, okay, I am putting a strike price and now it's maybe at $9 or $8 and I'm like, okay, strike price $6, but if this stock comes down to $6, I'll sell it off and move on, right? Now the person who buys the put from you is hoping for it to come down to that price, okay? Because what happens is that they can now get your stock at a cheaper price.
It worked. It worked, Mr. Chips.
This ain't no allegedly.
Delete your new map. We're about to blow up. Whoa!
Investors with an investment objective of speculation and capital preservation utilizes the long put option strategy. A put option gives the investor the right to sell a stock at a strike price with a specified time period. Now the put option gives the investor flexibility to sell the stock at a later point in time if the stock declines in value. See, so it's a way of hedging your stock or your position in a company. Like if it goes down more, then I'll just take that little loss and move on. So if that price, so for this, the investor pays a premium. So when I buy a put from someone, I would pay a premium. Like, okay, if this stock comes to this price, right, then I'll sell it off. I have the right to sell that stock, you know, at that price. So for this, the investor pays a premium for a put, which gives the right to sell, see, 100 shares of the stock, okay? Now the maximum upside potential in a long put is the strike price less the premium. The maximum potential of loss is 100% of the amount invested in the long put. So if it doesn't get to the strike price, I would lose that premium I paid to that person, okay? So it requires a considerable level of risk tolerance. Now, an investor who has a bearish outlook on a stock anticipates that the stock price will decline beyond a certain price point by a particular set date of this strategy. Now, with this, I won't even look at this to explain this to you guys. So, this is how it goes. I bought a stock at $7. Now that stock has gone down to $6. I'm like, will this stock keep going down? If it will keep going down, then at $4, I will sell it off and move on, okay? So I, as you know, the seller now says, okay, at $4, if it goes down, because they bought it at, $7, right? If it goes down from 7 to 4, then I'm cutting my losses off. The seller is cutting their losses of 300 and moving on. Now I, the buyer or that is investing in this, I'll buy the put, which is the put option. I'll buy the put. I may not have this stock, but I want this stock because I believe in the stock. But I just want it at a less expensive price and hold on to it. So I'll say, okay, I am paying, let's say, $40. If this stock comes to $4, I'll buy, the rest of it and bounce. Now the person who sells, guess what's gonna happen? Now that person has taken their loss and they've moved on. So now the strike price would be what we've agreed on, $4, right? So the person who sells takes the premium from me and holds on to it. So if this stock gets to this point of $4, I now own the stock at this cheaper price. So this person who sold it is hoping that this stock never gets to $4 or below $4. So I, who bought this, I'm hoping that the stock comes in or gets to $4 by this specified time, which is the expiration date, on or before I can buy if it ever falls down to that price. So I should have money ready just in case it falls, okay? So the person who sells wants it to be out the money because they are holding this premium now, so they want it to be out the money. I, who bought this put, I want it in the money because the more the stock falls, the more I, who bought this put, this long put, would make money because now every depreciation I'm making money. And this person who sold will be losing money.
I'm back, I'm better.
When you buy a put, you're betting that the market will keep going down, so you'll be making money. But if you sold the put, you would lose money if the market keeps going down. But if the market starts going up, I, who bought the put, would lose money and you would make profit because you would keep the premium I paid and you keep your stock. But if it goes below the $4 we've agreed upon, I, who bought, would keep your stock and I'll be making more money, okay? Because now, then after the expiration, the stock is mine. If I want to keep it and it appreciates in value, it's all mine, you see? So the maximum potential loss is the premium paid for the put multiplied by 100 shares. So this is calculated as follows. Maximum loss per option is equal to the premium paid times 100 shares. See, that will give you the loss. The break even is the strike price of the $10, where the option, the premium, you can take it and you can give it back, but the premium becomes yours. No money is made, no money is lost. So that's why it's called the break even point, okay? Where you guys have like an agreement, like you come to an agreement to give and take, where you guys are like, okay, we accept this, we can take this and move our separate ways. Compromise. A compromising point is called the break even point, okay? Then the maximum potential profit is the strike price of $10 minus the premium received multiplied by 100 shares, and this is how it's calculated. The put option strike price minus the premium times 100 shares. It's always times 100 shares. People should not forget that part because I know. So see, the investor anticipates that the stock price would decline in the next 3 months. See, so the stock trades at $10 for 3 months. Now they've paid the premium exactly. Now the investor who buys it is like at $10. You can keep my premium, but if it gets to that strike price, I am taking your shares, I am taking your stock, I am bouncing, okay?
Wait a minute, who am I? That's a Raven moment.
So now if I pay the premium, right, if it now gets to that price, I can pay more than that price. I have to pay that price that we've agreed upon. You see, deducted by the premium. The premium will be deducted. Exactly. So that's why the potential profit is the price of the stock minus the premium. So now I, who got the stock, I'm getting it at a less expensive price. You see what I'm saying? But the loss would be when you're losing the premium, and then you're losing, you know, so the maximum potential loss is the premium of $2 paid for the put option multiplied by 100. So if the strike price is now achieved, I, who invested in that, would lose that premium. But if the strike price is achieved, the person who sold it would lose, but I would benefit from that premium, because now I'll be buying the stock less the premium. That's the best way to put it. So this is the graph there. So you should also know that if the stock remains above the $10 strike price, it will expire worthless, and the investor would lose that premium, you see. But the person who sold the put will keep the premium. That's why you should be very careful. So that's why the premiums are not too high, but sometimes they can be so high, you're like, are you sure this is real? Okay, so I hope this helps someone out there to finally understand this long puts, what it means. Okay, the long put is when you have a strike price and you're like, okay, if it gets to that strike price, I'll buy it from you, and you can bounce. And the person selling is like, okay, you shake up on it. Okay, now if it gets to that price, you're keeping it, you who bought it, but this person loses their shares and just move on, you know, with their, you know, because it's like an advance payment for the stock from you, the person who invested in it. So you who invested in it, you're hoping for it to go into the money. The person who sold it is hoping that it stays out of the money. I'll see you guys soon in the next video. I love you all so much, but this is so fun, honey. Bye, guys.
'Cause I'm loving myself real good. Did you guys hear that? I'm scared. In a way that you never could.